Almost every single day as I'm doing my research and normal routine here looking at the markets, I'm seeing some chart, some evidence, someone claiming stock market's expensive. This stock market is high. Valuations are high. Well, if that's true, what does that mean? Where does the market go from here? I've got some updated perspective coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so on the spectrum here, is the stock market low or is the stock market high? I think we'd all say it's high. Okay, well then, on that spectrum, is the stock market cheap or is the stock market expensive? Well, that one might not be as easy to tell, but in my research and part of my role here at Korhorn Financial Group and the various hats that I wear is, doing a lot of investment research, and just about every day, I sort of tease with one of our all-star CFPs, Ben DeBach, pretty much every day I see a chart of someone showing the stock market's expensive, the stock market's overvalued. It's almost every day, if it's not every single day. And so lots of people looking at valuations, looking at data, looking at how today's data compares to history says it's expensive, okay? I'm not gonna argue with that, all right? Because I see those charts, pictures are worth 1,000 words. We're gonna look at some charts here in just a moment. And I have to agree, yeah, historically, market today does seem expensive. So what's that mean? Is all hope lost? Actually not. I'll share some perspective. Let's first take a look at the run, okay? This historic run that the stock market's been on. Now this is a chart of the S&P 500, okay? And it goes back, what I think is very helpful, goes back through the last 3 recessions, okay? The 2 big financial crises, the tech bubble and the great financial crisis, the Great Recession, whatever they're calling it. And then the coronavirus, the little blip that was a straight down, straight back up, okay? So take a look at this chart. Right, we saw the stock market surge in the late 90s thanks to the tech bubble and all the euphoria created with investing at that time. And then when the tech bubble burst, the stock market dropped, and it was at the time the biggest drop since the Great Depression. Took a couple of years for that to happen. Also, there was 9/11 and some other challenges during that time. But 2002, late 2002, 2003, things started marching back up again, and the S&P 500 got just about higher, okay, similar level to where it was at the peak of the tech bubble, and that was in 2007. Things started dropping, started declining because, is this subprime crisis actually a big deal? No, it's not. Trust me, it's over. July of 2008. Government was saying, no, this is pretty much contained. And then wham, it was not contained. We had the great financial crisis. And the market went back down to similar levels before, that it dropped to back in 2002. And then we started this unbelievable straight up rally, as you can see here. And the 2020, the spring of 2020 market dropped straight down. All the stimulus pumped it right back up. I mean, it's been unprecedented. Over 400% return since the bottoms in 2008. So, and you can look at some of the details on there as well as price to earnings and some of the yield information as well. But no matter how you cut it, it's been an unprecedented rise. And you could argue here, hey, between low and high, the market's high, okay? And based on PE ratios, that's the price you're paying for earnings. And in this chart, we were using forward earnings, so future expected earnings, which is much more helpful than past earnings. Past earnings right now are all screwed up because of the economy and the shutdown. So it's almost irrelevant. It's forward earnings that really matter. Right now, we're around 21, almost 22, and at the high in the tech bubble is 25. So we're pretty stinking close. You'd argue market's high and both expensive. All right, so then I'm going to geek out with you. Does that mean, okay, the market's going to drop? Take a look at this chart. Now this is, if you're not into stats, and I'll just talk you through this, but it shows the 1-year return on the vertical axis, and it shows the PE ratio on the horizontal axis, okay? And over 1 year, take a look at that at the first chart on the left. The 1 year correlation between PE ratio and 1 year average return, who knows? Who knows? There's no way to predict what the stock, with any level of certainty, what is the stock market going to do within 1 year based off of the PE, okay? So anyone like me on YouTube or on the radio saying, oh, market's expensive, watch out, go to cash, no one knows. No one knows. It's a leaf in a hurricane. You just cannot chart its course. Okay, but what about 5-year returns? Now that's the chart right next to this one. Over 5 years, you can see that there's more correlation, there's more predictability, there's more historical evidence that as that PE ratio gets higher, so that's that horizontal axis, the 5-year annualized return gets lower, okay? So again, it's not certain, nothing is, because the future's not been written yet, but there's more likelihood that the higher the PE ratio, the lower chance of high average annual returns over the next 5 years, okay? So by this, you might look and say, okay, so you're telling me, watch out. You know, you're telling me the stock market might not do as much if the returns have, if the PE ratio is high. And possibly, okay, possibly. But this is helpful for perspective. But again, the Wise Money Show is all about taking action, taking your next wise step. So does this mean, well, then I should just put my money in cash, or should I get out of the stock market, or should I be speculative with Dogecoin or some Bitcoin or some meme stocks? Well, not exactly. There's hope, okay? And what do I mean by that? The stock market is not a zero-sum game, meaning if the market goes up 1 year, it's got to go down the next year. It's not a zero-sum game where it's someone just, bouncing a yo-yo up and down. Well, it goes up to about wherever the person's holding their hand. It goes down to about their shoelaces, then back up and down. It's not like that, okay? I remember actually my late father-in-law back in 2007, he told me, he's like, hey, what do you think? Should we sell all our investments? Because the stock market's pretty much back to where it was before the last crash. And, short term, he was right. But I was like, hey, I love you, but it doesn't necessarily work that way. The stock market should always be making all-time highs. It's not someone just standing still bouncing a yo-yo back and forth. It's someone walking up a hill bouncing a yo-yo. Yes, that yo-yo does happen up and down, up and down, up and down. But over long periods of time, that they're walking uphill. There's an uphill trend. Focus on that uphill trend, not that bouncing, okay? So what do I mean by that? Take a look at this chart. This is since 1950 to 2020. So that includes 3 of the worst stock markets since the Great Depression. Maybe all of them, right? I mean, yeah, all of them, because it was the 60s, early 70s, it was 2000, it was 2008, it was 2020. So they're all in there, okay? And this shows the 1 year range of returns that the S&P 500 saw, that's the green bar, stocks, that the bond index saw, that's the blue bar, okay? And then a 50-50 mix, which most people don't have, just a 50-50 mix between U.S. stocks and the bond index, but the actual range of returns, the low and the high. So over a 1 year time period, the worst return over those, 70 years was down 39%, pretty sure that was 08, okay? And that's not a 12-month return, that's not rolling 12-month, that is a 1 year, calendar year return. Okay, and then the best year was positive 47% in stocks, okay? The worst year in the bond index was 8% down. The best year was up 43%. Wow, that's crazy. And then a 50-50 mix, the worst year was down 15%. The best year was up 33%. And then all other of the 70, so that's the bottom one, that's the top one, and all other of the 68 years are embedded within there. So that's 1 year. Again, pretty random. And you've got to make sure that you've got the right risk tolerance, the right mix, so that you can stomach whatever the ride is, okay? Because look at those 5-year average rolling returns, okay? 5-year average. Now you're looking and saying, boy, so this is average, this isn't actual, and it's rolling, okay? So it's not just 2015 to 2020, 2010 to 2015. They're rolling 5-year periods, okay? Look at that. Your stock upside is 28%. Your downside is 3%. Your bond upside stock upside 28%, downside 3%. Bond upside 23%, down 2%. And your 50-50 mix, upside 21%, downside is 1%. Shift that to the 10-year time period. Up 19, down 1. Up 16, up 1. Up 16, up 2. And then take that to 20 years for those of you my age, similar age, in your 40s, or even if you're in your 60s. Likelihood is you're going to live into your 80s, almost 90. So you still have some 20-year time horizon, right? So 20-year rolling, up 17, up 6, up 12, up 1, up 14, up 5. Guys, this includes times where the PE ratio is really high, times when it's really low, times when there's a flash crash, 1987, Black Monday, times when there's a pandemic, times when there's a tech bubble because there's a new craze or something like that, and then, maybe we're too early, maybe that's not going to pan out. I mean, there's president assassinations, there's controversial presidencies, there's all sorts of conflict. There was even war in this time period. I mean, this covers most of it. And this is why, short of an alien attack, we've seen just about everything in here, right? In this 70-year time period. And it shows that, patience, discipline, and not overreacting, over-adjusting is rewarding to long-term investors. So even though, here's the takeaway, even though you might see someone like me say, hey, market's high, I've said it plenty of times here, not because I want you to be afraid, because I want you to make sure you're taking a wise approach with your money and your finances. So don't overreact if the market seems high or seems overvalued, or there's data saying it's overvalued. It's happened before. It's happened before, okay? For you, you've got to make sure that you're taking the right level of risk for your situation, for your overall financial goals. And then you've got to make sure hands off the wheel, okay? That's why we recommend people have a diversified buy and hold approach, which has done phenomenal this year, okay? Just hold these indexes really, really cheap, make sure they're the right recipe, and then complement that with a momentum strategy, one that's not going to move with the market. It's going to overweight and underweight based on the momentum of the market. Significantly outperformed last year as momentum was very, very clear, and it helps guard against a big pop in the market or a big bubble burst in the market, all right? So a diversified buy and hold complemented with the momentum strategy combined together so that you don't have to overreact. You can let it ride and connected to your overall financial plan. That's what you need. Work with your certified financial planner on that. If you don't have a CFP that's helping you with that, or someone on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. Wise Money Show. You can find us there too, or just give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.